All right, welcome out traders to tonight's special YouTube webinar. This is Coach Tyler Craig with TacleTrading.com. Getting my ducks in a row here and we'll be ready to rock. Muted. Booyah. All right. Fun stuff planned for tonight. We've had a pretty volatile market the last week. And so I wanted to discuss a tactic, a trading strategy that is timely, that I think is relevant to what's going on in the market right now. So we're going to talk about how to sell premium in a high implied volatility market. How to sell premium in a high IV market. Let's grab my Word doc here. Okay, so what I want to do, hello Lorena, hello Patricia, welcome aboard. Thanks for hanging out this evening. I will be monitoring the chat window with YouTube. So if you guys do have questions or comments, feel free to throw those there in the chat. I want to start with a couple of definitions, get us on the same page, and then we'll go through some examples. Okay, we'll build some trades tonight and hopefully give you some insight in terms of how I would be adjusting my portfolio and or looking for trades in this market. Okay, so first things first, what do we mean sell premium? And what do we mean it's a high IV market? What do we mean high IV market? Okay, let's talk about options for a second. So in the options market, you have calls and puts. You have call options, you have put options. There are two things you can do with these contracts. You can buy them or you can sell them. You can buy them or you can sell them. And the question then is, well, which one should I do? Should I be an option buyer? Should I be an option seller? Should I do both? The answer is it kind of depends in large part on what market or what type of market we're in. So the example that I was taught when I started, let's say you go to Best Buy and you buy a computer. And as you're going through the checkout, the cashier says, hey, do you want to add a warranty to this computer, an extended warranty? And the answer is, well, how much is it? Okay, so do you want an extended warranty? Right, they sell these with all big like appliances, computers. What's up, Dennis? Guitar Flip, Gino, hello, hello. Grant, Thiago, Barat, good to see you guys as well. Do you guys usually buy extended warranties when you buy a computer, a washing machine, a refrigerator, a car, even an extended warranty? How many here are fans of buying extended warranties? And how many here are not fans? Where you're usually like, no, not going to do it. Don't give me that extended warranty. I don't want to buy it on this computer. While you're answering, I'll tell you my answer. My answer is it depends. What's the price? What's the price? If I buy a $1,000 computer and I can pay $10 for a 2-year extended warranty, yes, I will do it. Okay, I will do it. Sure, easy. Is it usually $10 though? Is it usually $10 to buy an extended warranty on a $1,000 computer? No. They'll say, hey, we'll charge you $200 for and I'm just making this up, and a 2-year extended warranty. I misspelled that. Extended warranty. $200. And I'm like, no, screw that. You're going to charge me 20%? No way. 20% of the cost of the actual product for the extended warranty, not going to do it. Okay. So whether or not I'm going to be a buyer of an extended warranty depends on the price. Okay. Most of the time they're really expensive and I'd rather be the one selling the extended warranty. Wouldn't you? It's a pretty good business model. I bet that they rake in a lot of money. I bet that these companies that offer extended warranties on things like phones and computers and refrigerators, I know they rake in the dough. They are profitable companies because they price them usually quite expensive. So I don't really have extended warranties on stuff. My appliances go out. If my computer goes out, I'm buying a new one. My phone blows up, I'm buying a new one. Okay, because I think over time that is smarter than, you know, buying all these overpriced warranties. Options are the same thing. Okay, options contracts are like these extended warranties. Okay, do you buy them? Or if I gave you the chance, you know, could you be the one selling the extended warranty? Well, the answer is it depends on the price. It depends on the price. So in different environments, options become more attractive to buy because they're really cheap, or they become more attractive to sell because they're really expensive. So rather than just saying categorically, I always buy options, or categorically, I always sell options, what the veteran trader, the more sophisticated, more advanced trader that has a better understanding of this, they're probably more open-minded. They say, well, it depends. It depends. If options are cheap, I'll buy them. If they're expensive, I'll sell them. Okay. So when we sell an option, another way of referring to that is you are selling premium. Okay. So if the call option costs, if a call costs $5, that's the premium. That's the premium or the value of the option. So when you're selling options, we could say you're selling premium. It's a synonym, same thing. Okay. So I could really, instead of saying how to sell premium in a high IV market, I could say how to sell options. And we'll find out here in a second, high IV means they're expensive. Or why I would be selling options right now. Why one of the silver linings of this sell-off is you now get paid more money for selling options. How do I respond to the market having a big correction like this, to tech stocks dropping 10%, to the VIX jumping almost to 40? What's my response? Well, I sell options. All of a sudden, people are buying a $1,000 computer and I'm able to sell them a 2-year extended warranty for $400. Why wouldn't I want to sell that warranty? They're paying me a lot of money for it. It's even more attractive. So we're going to talk about selling premium. We're going to talk about selling options today. Why? Well, because they're expensive right now. So that's the second piece of this, a high implied volatility market. Are options cheap or expensive? I don't know. Check implied volatility, or IV for short. So IV is the indicator, the signal that tells us if options are cheap or expensive. And in general, when you have a high IV, high implied volatility, options are expensive. You can sell these extended warranties for a lot of money. If implied volatility is low, then we'd say options are cheap. I really don't want to be a seller of these extended warranties. I don't want to sell a 2-year extended warranty on a $1,000 computer for $10. I'm not getting compensated for the risk I'm taking. Don't want to do it. So option traders that are knowledgeable and have some experience, they usually use implied volatility to help guide them in determining, hey, should I buy options or sell options? Helps you know which strategies are maybe the most applicable or the most attractive in the current market environment. Does that make sense? So that's what we're talking about tonight. How to sell options in a high implied volatility market. How to sell options when they're really, really attractive, when they're really expensive and you can make a lot of money by selling them. Okay. We're in that type of market right now. Now, because the market bounced today, they're not as expensive as they were yesterday. Volatility has come down. But let's continue the story here. So Thiago's asking a good question. So what do you check for implied volatility? If you want a general feel for implied volatility, you could just use the VIX. You could just use the VIX. So I could come in and I could look at a chart of the VIX. It's like if you want a general feel for the stock market, you could just look at the S&P, right? S&P gives you a general feel for what the stock market's doing. In general, we're bullish. Had a pretty big pullback the last couple of days, but the overall trend is still up. In general, are options cheap or expensive? Well, go look at the VIX. The VIX, here's like an SAT statement. The VIX is to option prices as the S&P 500 is to individual stocks. So the S&P 500 is a good barometer, a good proxy for what individual stocks are doing. The VIX is a good barometer or proxy for what option premiums are pricing in, for whether they're expensive or cheap. Okay, so when I'm making just general comments on the overall market, I'll use the VIX as my barometer. Okay, now the part of the problem with me making a point right now with the VIX is March is kind of throwing everything out of the, it's thrown a wrench into this chart. It doesn't look like the VIX went up very much this last week because March is looming large over every spike right now. March looks like 2008. Okay, this was like the biggest spike we've seen in the VIX since 2008, essentially. And so it's making you think, oh, Ty, it wasn't that high. You know, it only went to 38. It didn't go to 90 like in March. Well, you only get something like what happened in March once or twice a decade, if that. Okay, so it's kind of screwing up your perspective a little bit. If I zoom out and you kind of take March out of the equation, go to like a 10-year weekly chart, you will see, if I draw a line where we popped to yesterday on the VIX, if I just draw a horizontal line at 38, how often do we spike to 38 on the VIX? Well, we did it in 2011, 2015, 2018, earlier this year, and this week. Well, I don't know about you, but I'm counting 1, 2, 3, 4, 5, 6 times in the last 10 years. The VIX has spiked to 38. Is that common? No, it's very uncommon for the VIX to spike that high. Okay, so when you look at the history, I don't know why that jumped to Neo. When you look at the history of the VIX, pop to the upper 30s is a really big move. We had a big spike in the VIX this week, had quite a bit of fear and panic coming into the marketplace. Okay, that was noteworthy to me. That was noteworthy to me. So general feel for whether implied volatility is high or low, use the VIX, okay, spikes above 30, and especially, to 38, which is what we hit 2 days ago, are rare and definitely indicate options are expensive. Okay, we can pretty much say that definitively. Okay, haven't they been saying the VIX has been broken lately? Well, I don't know who they is. I don't think the VIX is broken. My opinion is it works just fine. Depends on what you're using the VIX for. Did the VIX give you a good indication there was a lot of fear in the marketplace this week? Yes. Did it give you a good indication that options were expensive, and if you sell them, you get a bigger payday? Yes. So gave me the signal I needed. I don't know what else we would have expected. A jump to 40 in the VIX is a pretty good signal, historically speaking. So I think it's behaved like I would have expected. In fact, I could make the argument that the VIX has been too high for a long period of time, that it should have maybe come down a lot sooner or a lot quicker, because market volatility hasn't been that high at all, not counting this week, of course. Well, Matt's not a huge fan of the VIX. So just categorically, he has his predisposition, and he didn't really like the VIX. He doesn't really use the VIX, which is fine. It doesn't mean he's wrong. But knowing Matt, I know that he tends to just not really like the VIX. But it depends on what you're using it for, to be fair, right? So for my purposes, it works just fine. Now, if you said, well, take the VIX out of it, can you teach this a different way? Because I got a little stink factor. There's a stigma in my mind with the VIX because I've heard Matt beating it into the ground. Okay, fine. I mean, I can show you a different way. We don't have to use the VIX. I could just go to the S&P and pull open the implied volatility indicator. It's the same thing as the VIX. Implied volatility indicator for the S&P 500. Okay. And I can see, again, March blew everything out of the water, so it really screws up the scale. But I can see that implied volatility popped this week in the S&P. Okay, that we had a spike in implied volatility. I can see on the NASDAQ that we had a spike in implied volatility this week to its highest level since March. Okay, I don't need the VIX to illustrate that. I could just use the implied volatility indicator. I like to use the IV rank or implied volatility percentile. So that's an indicator that I kind of prefer to use myself. So if I look at that, I could see, yeah, okay, we had a pop in implied volatility in the NASDAQ. And that's echoed around the street. If you go look at Apple, Apple had a spike in implied volatility above the 50th percentile, which is the upper half of its range, right? You look at Amazon. Amazon had a spike in implied volatility this week, jumped up to the, 70th percentile. It doesn't really matter, okay? Whatever metric you look at, they're all going to say pretty much the same thing, and that is that options got expensive this week. The VIX was up at 38. Implied volatility shot up on all stocks. The implied volatility rank on stocks went above 50. You use whatever metric you want, okay? Options became expensive. Options became expensive, okay? So what's the takeaway? Well, the takeaway is if you were willing to sell options today, yesterday, the day before, into this spike, you've made good money today. Today specifically because volatility came back down and the market started to rebound. So can we all agree, before I move on to my next point here, taking 15 minutes so far to explain this, can we all agree that we've made the case that options have become expensive? They are thus more attractive to sell than they have been in many weeks, in many, many weeks. Okay. Yes, right? We're all in agreement. I don't know how you dispute that, to be honest. I don't know how you dispute it. So then the next question, the next piece is, well, how should I sell options? How should I sell options here? I mean, think about the different ways you could do this. You could sell options and create a bullish leaning trade. You could sell options and create a neutral type of trade. You could sell options and create a bearish type of trade, right? You could sell options and create a bearish type of trade. So the first thing that we do know is I want to sell options. I want to sell options. So by the way, if you sell options, that's also known as selling premium. It's also known as selling volatility. Also known as selling volatility. In Greek speak, you are entering a negative Vega trade or a short Vega trade. So when I say, okay, how do we sell options? What are the strategies that effectively get me short premium or short volatility or negative Vega? They're going to be the strategies, and I actually just said it, they're going to be the strategies that are negative Vega. Okay. Now, maybe you haven't memorized all the option strategies and you don't really know them off the top of your head, which ones are positive Vega, which ones are negative Vega. That's fine. I'll tell you them. But that number one, I want that to be a characteristic of any trade I consider. So if you say, Tyler, would you buy a call option? Well, no, because that's not a negative Vega trade. That doesn't take advantage of the fact that options are expensive. Hey, would you buy a put? Well, no, that's not accomplishing the objective I want. The objective I want is to sell expensive options. But see, there's a variety of ways you could do that. So you then have to kind of say, well, what is my directional bias? Do I want to lean bullish on this pullback? Do I want to lean bearish? Do I want to lean neutral? What do you think? Of the three, which are you the least likely to want to do, let's say as of yesterday? Or really, I mean, I'm gonna go back a day because it's a little bit harder to make the case today because we already did start to bounce. But let's pretend like we're yesterday. Would you want to short premium and go bearish, given that the market was already down 3 big days, the NASDAQ was down 10% in a row? For me, I would be the least likely or the least, willing to sell premium and go bearish. Not after the market goes down 10%. Okay. Go back over the last 10 years and tell me how often it made sense to go bearish after a big 3-day pullback. Okay. It's rare. Sometimes, March, you were fine going bearish. I don't want to chase bear trades after a big down move though. So when the VIX has spiked like that, the market's already sold off quite a bit. I'm not usually selling bear trades or entering bear trades by selling premium. I'd be the least likely to do that. Okay. Now, if I wanted to do that, just so you know, you would do this by selling calls. You could sell a naked call. You could sell a bear call spread. Those would be the two most common. So generally, I'm not going to do those two. Not at this case. Not at this situation. Big 3-day pullback sitting at potential support. No way, Jose. I'm not selling calls at that point. I'd have been crying for my mommy today if I sold calls yesterday. Terrible timing. I would rather lean bullish or neutral. Of the two, I think it would be easier to lean neutral if you're scared of the pullback and you're like, I don't know if I want to step in front of this freight train and go bullish. Might have been a little bit easier to build a neutral type of trade. Bullish for me is usually the one that I do. My issue with bear calls is just convince me, let me go back a day, convince me I should do a bear call on the NASDAQ based on the chart. You just went from 303.50, you're down 11% in a straight line, you're sitting at the 50-day moving average. Convince me now I want to go bearish. Market implodes, it's down 11%, and now I'm like, okay, let's go bearish. No, my risk reward sucks. Even if it works, even if it would work, my risk reward still sucks. I don't want to do it. So Ahmad, my concern is I'm late to the party and going bearish, right? Or like look at let's look at some more. Okay, AMD. I don't know why that popped back. AMD yesterday convinced me I'm going to go bearish on that chart after 4 down days, sitting at support. Nope. How about Zoom? Convinced me I'm going to go bearish on this chart yesterday. 4-bar pullback, stellar uptrend. No way. No way. Convinced me to go bearish on NVIDIA yesterday. No. Now you might say, well, Tyler, you're cherry picking. You knew it went up today. Okay, fine. I'll go back 2 days. Convince me I should have gone bearish on NVIDIA 2 days ago. No way. Even though it worked for a day, I still wouldn't have done it. Because I didn't like the risk reward. So again, by the time, think about this, by the time the VIX has spiked and premiums are high, the market is usually oversold. You want to enter bear trades then? Not really. Not really. Not really. Okay. So now this is me speaking. I mean, I'm just telling you, I'm using my logic. You make your own decision, obviously. I don't like the idea of going bearish. I got too much experience. I know that usually I get hosed if I go bearish after the market's down that much. I'll get smoked on the way back up. Don't want to do it. Okay. Well, the lower high, yeah. I mean, look, that's a different story though, right? If the S&P pops a couple of days and forms a lower pivot high and then starts to roll over, different situation, different story, right? So I do agree with you. I mean, if we broke support on that downswing, popped a bar or two, hit resistance and rolled over, that's different. I'm talking yesterday, 3 days down, 4 days down, 5 days down, market's oversold, VIX is high. That's kind of my setting for today's discussion. Okay, if the market's bounced a couple of days, VIX isn't as high, different pattern. Okay. So again, this would have been a more potent discussion, I think, yesterday. Today's bounce took a little bit of the took a little bit of I mean, it proves the wisdom behind the techniques I'm teaching, but it probably would have packed more of a punch if I taught you all this yesterday, and then you sold some puts yesterday, and then the market popped today and volatility came back down. That would have given you more like, oh, okay, it works. I get it. You know, I sold options when they were expensive. One day later, everybody breathes a sigh of relief. The market pops, and then, you know, I made a bunch of money on my short volatility trades. So some of the just the ideal pattern has been, the pressure's been let off a little bit. So it's still a valid point, but the entry for some of these strategies would have definitely been better yesterday. Okay, but don't worry, this happens all the time. Okay, this happens all the time. You'll get another chance. Okay, let's move this along. How could I go neutral? So maybe the sell-off was so aggressive, and maybe you were leaning bullish into this. If you were leaning bullish into this sell-off, you were probably hurt pretty bad the last couple of days. And maybe you're like, dude, I don't want to put on more bull trades. I'm already getting punched in the face. I don't want to add more exposure here. So if you already were leaning maybe too bullish into this, 3 down days, your appetite for risk is diminishing along the way because your losses are growing. So you're like, I don't want to go bullish selling this high volatility. Let me put on a neutral trade. That way I don't add as much exposure to my portfolio because it's already leaning bullish. Well, if you want to add a neutral short volatility trade, you would do something that is delta neutral. So you could sell a strangle. You could sell an out of the money call and an out of the money put. If you don't want to sell naked options, you could sell an iron condor. Okay, you could maybe do a butterfly. For me, most common would be the iron condor. So I will highlight the one that's the most common for each category. So iron condor, bear call would be the most common one for the bear. So somebody might have come in yesterday and said, hey, VIX is up. You know, and ironically, the VIX spiked and peaked the day before yesterday. But, you know, even yesterday, the VIX was still around 34, 35. So I say, oh, volatility's high. You know, let's come in here and sell a condor. So I'm going to sell an out of the money bull put in October, and I'm going to sell an out of the money bear call in October to capitalize on the high IV. And what that means, the reason it's attractive if you do an iron condor is you get more premium than normal because you're entering when the VIX is at 38 instead of 20. And you get a wider profit range, which essentially means you have a higher probability of profit if you enter when the VIX is high. Okay. So essentially what your best case scenario is, let me grab my tablet here. What you'd be saying with the condor, okay, here's our uptrend. This is what the market looked like last week. And then you went down, down, down. If I throw on a condor at this point, bear call up here, bull put down here, I'm hoping the market doesn't go straight up and just completely, I don't know, rip higher aggressively off of this pullback. I'm also hoping that it doesn't completely implode. Okay, I'm hoping that it kind of bounces around a little bit. So this was like the volatility shock to the market, and maybe it kind of hangs out a little bit and digests that move. And if while doing that, implied volatility drops, you got time decay passing, stock's not really doing a whole lot, volatility's coming down, that would work to the benefit of the condor. Okay. So if you think that's kind of the most likely outcome, that we maybe chop around a little bit because bulls are now a little scared because they just got punched in the face. So maybe we don't bounce too aggressively. But on the other hand, we just dropped a lot. So maybe most of the damage is priced in. So we don't go that much lower. That would be your outlook, your justification for maybe doing a condor. Okay, something like that. Now, if the market ends up imploding You're just hoping you got enough room on that range to where you don't hit the lower side. If we scream higher from here, you're just hoping we don't go up too far. Okay, but again, your bias, your preference here is that the market is likely to chop a little bit. So you want to do the condor. That is the strategy that kind of takes advantage of the high IV. So I've sold premium. But I didn't really pick up much directional exposure. I did it in a neutral fashion. So let me just show you what that would look like. Okay. So if I did that on the S&P, I'll just use SPY to make it simple. I'm going to go out to October. And I'm going to go, we've got to do a lot of strikes. I'm going to do a $4 spread. So I'm going to go down to like a 15 delta. I'll sell a 15 delta put. That's the 307, and I'll buy the 303. So that's 40 cents credit for a $4 spread. That's fine. And on the puts or the call side, I want a delta around 15. So I'll sell that guy. Let's go 363, and then I'll buy the 367, 43 cents. All right, so I'm at 363 and 307. 363 and 307, getting 83 cents. It's about a 20+% return. So 307. I'm actually just going to put a little box there. So I got my bull put down around 307. Got my bear call up around 363. Okay, so that could be one way of selling premium. And again, betting that the stock's going to maybe chop around for a little bit and digest this big drop. Now, you may say, I don't like the range, blah, 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 whatever. Okay, you can go further out of the money if you want. This one was about a 20+% return. You could go further out and get a 10% return. But the point here is because the VIX spiked, because options got more expensive, before this sell-off, maybe this was the range, the profit range for the condor, okay? But after the sell-off, now this is the range you can get because implied volatility is higher. So that's the point, okay? Now, would you have made money today if you sold this condor yesterday? Well, we definitely know that implied volatility came down today. So you benefited from the drop in implied volatility today in this iron condor. The question is, did we go up too far? Did we go up too fast today to offset that? Did I lose enough today based on the stock being too bullish than I made based off of volatility coming down? That would determine whether or not you had a profit. I don't know. I didn't put a condor on yesterday. That's not the way that I decided to trade this. I leaned bullish, okay? But that could have been a play that you could have deployed, okay? So I'm helping you with the repetition tonight. So what could I have done to take advantage of the high implied volatility? Well, if I wasn't comfortable going bearish because we already dropped a lot in the market, if I wasn't comfortable stepping up and going bullish, maybe because I was just shell-shocked at the speed of the descent, maybe because my portfolio is already bullish and I'm not willing to add any more exposure, and maybe I add the condor as my vehicle for, quote unquote, selling premium in this high IV environment. Now, maybe I wanted to go bullish. Maybe I say, hey, you know what? I'm willing to step up here. I think this pullback's a buying opportunity. Could I buy calls? You could. I bet if you bought calls yesterday, you made money today if your stock moved with the market. Could you do a bull call spread? You could. You're going bullish, obviously. But are you taking advantage of the volatility increase? Are you taking advantage of option premiums expanding during this sell-off? No. You only take advantage of that by selling options. So how do I sell options and get bullish? Well, sell puts. Go sell some puts. Have there been some stocks that you've been disappointed you didn't buy earlier? Feel like they ran away without you? Come back. Wait. Apple, you forgot me. I was totally going to buy you at 100. Come back. Right? Okay, well, I mean, he just came back for you. He's so nice. So maybe I could sell puts into this on stocks I want to own. You know, a lot of these give you discounts now. You get paid a lot more than you used to. I think you could sell puts into this. If the stock's too expensive and you don't want to sell a naked put, maybe you do a bull put spread. Those are the two most common strategies that I would use to lean bullish while selling premium in a high implied volatility market. Bull put would be the most common just because it's applicable to more stocks than a naked put because the price of the stock doesn't matter. Okay. Well, if you take a look, for example, let's look at AMD. I mean, AMD came back for us. It heard my cries at 94 and came all the way down to about 74. It dropped almost 20 bucks. Said, I came back for you. Okay. Well, the implied volatility also spiked on that. If you had bull puts on AMD and you entered them anytime in the last 2 days, you made a good chunk of money today. Why? Well, stock was up 4% today and implied volatility got whacked pretty hard. Okay. I have bull puts on AMD. I made money today because of those two factors. Okay. Did I pick the bottom in AMD? Nope. I actually think I had bull puts before this sell-off. I just added more at a better price. Okay. I said, oh, goody, a discount, a sale. I wanted more exposure on AMD anyways. So I sold more. Okay. So even though AMD is below my entry price on the first one, I'm making money. I'm making more on the second one to offset. I actually maybe break even on the first one at this point because the ball dropped. But anyways, Apple. You could have 2 days ago, even actually yesterday, I had an order and it did not get filled. So it did get filled the prior day though. You could sell 90.85 bull puts in Apple for 50 cents a couple days ago. So for Apple to go down to 90, this correction, we'd had to have gone from 138 down to 90. No way, dude. I mean, anything's possible, but 138 minus 90, it's almost a $50 drop. You know, it's like a 35% decline in Apple. Look, so here's the thing. If a stock that I really like, it's in a good uptrend, it had good momentum, if it's pulled back 10, 15% and the VIX is really high or the implied volatility rank is really high, and after going down 10, 15%, I can then sell a bull put that's 35% lower, at least from the peak, right? It would take that 10, 15% correction, morphing into a full-fledged bear market, dragging the stock down 35%. That's a trade I really like. I like that trade. Okay. Got a pretty good margin of error. Okay. Zoom. Did you guys see Zoom? I mean, Zoom goes from 478. Yesterday, it's down at 345. You can sell bull puts down at like 250. So for Zoom to get to 250 from the peak, it basically will have needed to retrace 50%. So Zoom had retraced about, I don't know, 20%. And then I can sell a bull put that would require it to drop 50%. Sign me up. I love those kind of trades. Okay, I love those kind of trades. Because very, very quickly, these premiums, which yesterday, you know, the world is ending, we're all going to die. Everybody's freaking out, buying out of the money puts, jacking up the prices. And then today the world doesn't end. All of a sudden the demand for puts goes way down. They get way cheaper and you make money really quick. If we get one more up day, even though we sold October bull puts which by the way, October bull puts are 37 days out, I'll make 80% of the max profit. You get a nice little 2-day pop, even though there's still 37 days left. Little bit of an up move in the stock, plus a nice volatility crush, a nice drop in volatility. You can make profits fairly rapidly. So one of the other nice things about this type of setup is it's not like a typical bull put in a low IV environment. Think about this. If I sell premium via a bull put, if I sell a bull put in a low IV environment, theta is really driving the bus. It's the variable driving my profits. And it's slow. It's so slow. Okay. I wrote an article about this. I think it was Options Theory or Tales of a Technician blog over at tackletrading.com a while back. And the analogy that I used is I used to mentor students every once in a while here in Salt Lake. And so they'd come out, and I had a neighbor that worked in downtown Salt Lake. So I'd carpool with him. And he drives insanely fast. Okay. Like he's a good driver, but he's like crazy aggressive. Okay. In contrast, I had another buddy of mine, and he drive like a 90-year-old grandma. It's like, dude, let's go, man. I got places to go, people to see, stuff to do. So my slow driving friend, he's like theta. Okay. You make money, but it's slow. The fast driving buddy, he's like Vega. He's like short Vega in a high VIX environment. You get a nice pop in the stock, you get volatility to come down, and pretty rapidly those premiums, which were expanded, which were really high, they drop pretty aggressively. So that's what you saw today. So for anybody who has short puts, things of that nature, I guarantee you saw profits come back quite rapidly today. Now, the ideal scenario would have been you sold puts yesterday and then you made a bunch of money today. But even if you sold puts 2 days ago or 3 days ago, as long as you added into the weakness, today was like your big payday. It was for me, at least. Okay. Now, I hope that we go up again tomorrow. Who knows? But if we can get a second good up day and a second day of the volatility coming in, dude, if I can make 50, 60, 70% of the max profit in 2 or 3 days on a 35, 37 day credit spread, I'll just take it off. And then what do you think I'm going to do if we go down another 3 days? Rinse and repeat. Like what I would love is we get a big drop, vol expands, sell puts and bull puts. We get a nice 2-3 day bounce, vol comes right back down, take profits, market rolls over again, VIX spikes up to 38, 40, sell them again. We bounce 3-4 days, VIX goes back down. You never get it again and again and again, like back to back to back. It would be nice. But see, that's where you start to look at this and you say, hey, I'm now going to view corrections like this more opportunistically and look forward to them, because I can never sell a 37-day bull put, make most of the profit in 2 days when theta is driving the bus. It requires doing it when vol is high and seeing a nice little volatility crush. That's what accelerates the profits on these types of trades. Okay. All right. So here's the worst case scenario for me. Okay. Worst case scenario for me is we gap lower tomorrow. Like if I didn't take anything off the table today, I will be disappointed tomorrow morning if the market opens down 2%. Because I'll be like, oh man, I should have taken some off at the close yesterday. I was gone. I had an appointment today, so I didn't do it. So I'm hoping we can get a little follow through tomorrow. Maybe we go out for the next 5 days. I don't know. It's just I'd like to get a little bit smaller into strength so I can get bigger next time if and when we sell off, right? And that's important. If you never get smaller into strength, if you never harvest gains, then it's harder to add into weakness. Okay. So how many feel maybe like they couldn't add bullish trades into this because they were leaning too long or too bullish, you know, last week. If you didn't take anything off last week, you're hesitant yesterday and the day before to add anything, you know, because you made money going up, you gave a bunch going down. Now you're just hoping to get bailed out on the way back up versus adding positions and enhancing your portfolio so that you can make money quicker on the way back up. Right? The recovery is always quicker if you can be strategic about adding good trades into weakness like this. Okay. All right. What about the exits, Heather? Would you take some of the profit earlier today or tomorrow? If I make enough of it, yes. So the thought here, like let's take Apple, the Apple October 90.85 bull put, but let's say I got 80 cents credit and it was a 38-day trade. Well, if 2 days in, the spread is worth 30 cents. So I've made 50 of the 80. I've made 50 of the 80. I've made about 63% of the profit in 2 days on a 38-day trade. I'd at least have a tight stop. I mean, if we keep going, I'll make more. But if we start to roll over, I'd take some off. It's got to be at least 50%, Damon. I would never get out quicker than that typically. Got to be at least 50. And these are high probability credit spreads where I'm not getting a ton of premium. Because think about it. I mean, if I sell a credit spread for 50 cents, 50% of that's 25 cents. I mean, what am I going to get out when I make 5 cents, 10 cents, 15 cents? Like, it's got to be a good chunk of the profit, right? So 50% would be a good minimum. 50% would be a good minimum. And remember, all I have to do, if I leave 30 cents on the table and there's 36 days left, all I have to do to be better off is make at least 30 cents over the next 36 days somewhere else, right? If the stock goes back down, I may throw the bull put right back on, just at a higher credit. Crap, I'd like to sell October bull puts 10 times between now and October. Sell it into weakness, buy it into strength. Sell it into weakness, buy it into strength. You know, and if I could scalp half the credit again and again and again and again, I end up at the end with 4 times the amount I would have made if I just rode the bull put spread for 30 straight days or 38 straight days, right? Now, I don't know if the market will give us that opportunity. If we just bounce and that was it, if that was the spike, that was the sell-off and we're up for the next 3 weeks, then I won't get, you know, a really quality opportunity. And see, that's the thing. These VIX spikes don't come around very often. So you start to relish them. Say, oh, it doesn't come around this often. This is a rare event. So rather than fearing it, I want to learn how to take advantage of it because we may not get another one for a while, right? So, you know, anyways. Okay. So what's another example? Okay, Zoom's another example because this is the one I looked at. So yesterday, and actually I'll show you a feature in Thinkorswim, which is kind of nice. So let's go to Think Back. Let's go to yesterday at the end of the day. Join me in my little time machine here. I'm going to go back to Zoom. And I know one of you asked about a stop loss. I'll get to that before I'm done. So we're going to go back to Zoom here. September 8th was yesterday. Zoom closed at 350. If I was looking at October bull puts, yesterday for Zoom, you know, I could have been maybe 270, 260. 270, 260, you got a $1.65 credit yesterday. 270, 260 bull put, got a $1.65 credit. Where's that trading at today? You're up 90 bucks. It's at 75 cents today. So that bull put in Zoom went from a $1.65 to 75 cents just today. So you made $90 of the $1.65. You've made 55% of your profit in this bull put in one day. You made 55% of the potential profit in one day. You put on a 38-day trade 1 day later. What percentage of the time is that? 1 divided by 38. You've had 2.5% of the time go by, and you made 55% of the profit. It's like a payday advance. They front loaded your return. They said, you don't have to wait halfway to expiration to get half of your profit. We'll jam it into the first 2.5% of the time. Give you 55% of the profit in the first 2.5% of the time. Say, well, thank you, Zoom. I knew I liked you. I'll take it. Now, could you hold out for more? Sure. But, would you let this go into a losing position? No. You dumb. Don't do that. Not at this point. But, that type of aggressive move doesn't happen when theta is driving the bus. Time decay will never give you 55% of your profit in 2.5% of the time. Can't do it. You need this potent situation where you have a VIX spike in volatility. Now, to be fair, Zoom went up 11% today. Okay, it's not like this was some mamby-pamby, 1% pop. So certainly it helped that the thing ripped higher. Okay, but even if it didn't, like you go look at AMD, for example, that only went up 4%. You go look at AMD yesterday, and let's just do a naked put to make our lives easy. Let's say I sold the 60 put. Let's say the 62.50 put, 12 delta. You sold that for $1.15. Today, it's at 70 cents. So not as impressive, but that's pretty good reduction in value in one day, right? All right, well, what if I'm wrong? Let's tackle that for the last few minutes here. So what if I'm wrong and the stock keeps imploding? Okay, so in the case of Zoom, let's say I did a bull put down at 250, and let's say Zoom shocks the world and it goes down 50%. It goes down 50%, 350, 340, all the way down to 250. At a minimum, you could get stopped out. Before I even go to anything with like advanced management techniques, whatever, you could just get stopped out, right? If it drops to my put strike, I could take a loss and move on. Okay, so at a minimum, goes down, hits my strike, I take a loss, I move on. If Apple goes down to 90, I take a loss and move on. That's one thing, okay? Look, if you do a gajillion contracts such that if it hits your strike, you're gonna jump off a cliff, no offense, but that's your fault, okay? That's your fault. I'll look right into the camera. That is your fault. Don't be an idiot. If you do one contract and hitting the strike, you lose 1% of your account, then it's fine. It doesn't even matter. It doesn't even matter. So Gino, we control the fear with the position sizing. Do a smaller size. What else could I do? Well, okay. And I'm talking specifically bull put, naked put, okay? So target, I talked about, take it quickly, take it if capture 50% plus of max profit quickly, right? Stop loss, 1, you could bail if stock breaks a key support level. 2, you could bail if we hit the short strike. Okay, bail if we hit the short strike. 3, are you willing to buy the stock? You willing to buy the stock? I'll buy Apple at 90. So if I sold one bull put spread in Apple for every 100 shares I'm willing to buy, and I know that means you got to have a lot of capital sitting on the side just in case. But I might say, okay, I mean, I'm actually mad I didn't buy Apple the first time it was at 90. So if it gives me another crack and we have a 50% drop in these tech stocks, guess who's going on a shopping spree? Maybe I allow assignment. Maybe I allow assignment. Okay. Add it to my portfolio. If you like the strike you sold, why not? What else could you do? You could trade around it by scaling into more contracts. Now, this is something I've taught in a YouTube special webinar before, the idea of scaling in. Okay, you got to go to the archives. I don't know where it's at, but I know I did a session specifically on scaling into naked puts and bull puts. Okay, so maybe I start with a partial position. I say, okay, I mean, let's take this Apple, for example. Okay, so here's this pullback in Apple. Here's this pullback in Apple. How's it going to play out? Well, I've got my put at 90, my short put or put spread. Could bounce and I'm right. Okay, maybe it pulls back a little further. I was early, missed it by this much. Pulls back further and then bounces. It's not a 10% correction, it's a 15% correction. Maybe it pulls back even deeper before bouncing. Do you think it's going to drop to 90 in a straight line? 138 to 90 in a straight line without a bounce? Probably not. So I use a baseball analogy, okay? The pitch is coming. I'm like, okay, 4-day pullback. I think we're good. I swing. And I think I got a good entry on my bull put 2 days ago. And I missed. It pulled back another day. Well, it's not one strike and you're out. I can do 3 entries, 3 strikes. I want to do 3 contracts. I'll do one later, instead of 3 all at once. Okay, so then Apple pulls back to 100 and then starts to bounce. And I'm like, okay, good pitch. Let's swing again. So then I try my second one. First one was here. I was wrong. Bozo, swing and a miss. Comes down to 100. And I'm like, okay, now I really like this pullback. I really think we're close to a bounce because it is oversold. Swing again. Now, maybe I put it in play and I'm like, nailed it. Got it on the second one. And then it bounces off of 100. Great. Now I'm in 2 of the 3 contracts. Maybe it pulls back close to 90 and then starts to bounce. And I get in a third one. So I don't like trading techniques that require me to nail the perfect entry because it's not possible to do every time. Okay. I thought I nailed it on Apple 2 days ago, and then yesterday it went down again. I'm like, oh crap, maybe I'm early. And then today I went back up and I'm like, okay, no, maybe I did have a good entry. And you don't know until after the fact. I'm speaking with confidence today because now I know the market bounced and anything you did over the last couple of days was smart, was selling premium. Doesn't always work out that way. So it is important to have a contingency plan. And for me, I use the scaling in technique. Get multiple chances. Okay. And sometimes, after maybe scaling into a second one, if we form a bear retracement, I might add a bear call. I might add a bear call to hedge, and then if we start to roll over, I make money on the bear call to help offset what I'm losing on the bull puts. So you just start to look at this a little bit more fluid as opposed to, please, Apple, if you go to 90, I'm going to die. Like, forget that. I mean, you put way too much pressure on yourself. You put all your contracts in on one entry and it didn't work. And now, you're just biting your nails all the way down to 90. Now, I'd rather take the lemon, make lemonade, use scaling in, trade around it, and try to improve my positioning. Okay. All right. There you go. Them's my management ideas. It's my management ideas here. Okay. Michael, I just finally saw your question. So guys, I will just tackle questions for the next couple of minutes. If you want these notes, you can email team@tackletrading.com and they'll give you the notes. But yeah, let me I'll take questions here for the next couple minutes. Oh, by the way, we are doing, for those of you that have the bear market survival guide, we do have a mastermind group meeting coming up in a half an hour. So Tanya and I will be hanging out for that. So if you are bear market survival guide owner, come join me here in 30 minutes. We'll be talking about bear market stuff. Okay, Damon, would you wait for intraday comeback for these trades, or you just go for it when options are overpriced? Damon, yes, I do want some kind of upward confirmation. So when it comes to pulling the trigger, if I'm going bullish, I want to see some kind of upward move. So when you look at the trigger, one, I want to break prior day's high. If that's too far away, I want to break above intraday resistance. So look, if I look at the 5-minute chart and we're on the third down day and it looks ugly, it's like 5-minute chart, like bam, 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 and we're sitting at the low of the day. No, I'm not going to do a bull put. I need some confirmation it's going to start to go back up. Now, if the 5-minute chart starts to turn higher, then I may say, okay. Yesterday, the intraday chart did turn bullish. Even though we closed at the low of the day, when you look at the 5-minute chart on the S&P, we broke intraday resistance yesterday morning in the S&P. I could see somebody getting triggered in on a bullish trade. Same thing with some tech stocks. Apple yesterday morning did break some intraday resistance levels. It rolled over at the end of the day, so it ended up being a ruse. But we did see intraday strength yesterday, and we did see intraday strength the day before. So if you use intraday triggers, I could see somebody getting triggered in yesterday and the day before. If you were waiting for a break of a prior day's high, obviously using Apple or the S&P as example, we didn't break prior bar's high even today in the S&P. But that's what happens when you get a big bar like that. If you're waiting to take out the high, sometimes it takes a long time. And in this case, you miss the best part of the bounce. Or at least the part that, where volatility drops the quickest. Ahmad, I will be on the lounge on Friday. I don't know who's in the Traders Lounge tomorrow, but it ain't me. I'll be there on Friday. Okay, I think that was the last question. I'm going to let you guys go. Thanks for hanging. Practice up on these techniques. Okay, for those of you that have the bear market survival guide, this is also known as the fade the fear trade. Okay, we're fading the fear, which is that spike in volatility. Okay, all right, so those are ways for selling premium in a high implied volatility market. See you next time.